Hello everyone, this is Pineberry Mommy. Welcome back to my channel. Yesterday I watched Cathie Wood's interview with Yahoo Finance. During the interview, she quoted Tom Lee's research of how millennials can help to push the stock market higher. It's not about Robinhood or WSB. It's about how to view the stock market from a demographics perspective. I was quite interested in that and was surprised when Tom Lee said it. So I did some research and found most of the video clips were taken before Tom Lee got famous, so not many people actually knew of it. I compiled 3 related videos together where he talked about the impact on the stock market and also the crypto market. I really enjoyed his angle and the wisdom of using alternative data to view the market. Hope you will enjoy the videos too.
Yeah, I'm going to give a shout out to Tom Lee from Fundstrat. He picked up on a study that Stan Salvikson, who was the chief strategist of Merrill Lynch in the 80s, when I was just coming of age in this market, Stan had a hypothesis that the baby boomers would make for 15 to 20 years of a bull market in equities. And that's what happened. It was a very simple assumption, and it played out beautifully. Tom Lee, I don't even think he referenced that study, but has taken the notion that millennials are the reason we're in a bull market for equities, and that this leg of the bull market won't end until 2026. And I think he thinks that the bull market, with some fits and starts after that, could actually extend to 2038, I believe it is, which is the year that the number of millennials peak. So this is the echo of the baby boom. I lived through the baby boom years and that equity market move. It was magnificent. It was a very simple assumption, and it worked. And I do feel we are in the same place now.
All right, equity markets overall. We've seen a nice recovery, even at this moment today, a little bit. But overall, you've been positive. Do you remain so?
Yeah, I think it's still one of these markets where more investors are, sitting on too much dry powder, and not a lot of people have house money to play with. So I think it's still a market where you're going to see the dips being bought. And then I just think that you still have this big, powerful demographic tailwind taking place. It's a reason the U.S. decoupled this year, but it's also a reason why we're starting to see, I think, next year potentially kind of a reacceleration of growth and upside to S&P earnings.
And that is what? It's related to millennials, I know. You've talked about it in the past, but give us some specifics.
Yeah, what's happening is millennials are really causing a pretty big jump in the 30 to 50-year-old cohort, and that's the most important segment of any country's economy because they're the prime income earners. They're also the ones that consume credit, and for the first time really in almost 12 years, the number of 30 to 50-year-olds is actually growing again. And if you look at sort of the size of the millennial demographic, that growth is set to take place for almost a decade. So it's a tailwind that we haven't seen in the U.S. economy really since the mid to late 70s.
And Tom, you see this specifically as kind of a U.S. tailwind, right? How come other countries aren't experiencing the same kind of demographic tailwind from millennials? They have millennials all over the world, right?
Yeah, I mean, millennials it refers to people born between 1981 and 2000, but the U.S. actually had a fairly large boom in terms of births around millennials. If you look at Europe, Japan, China, the number of 30 to 50-year-olds is actually contracting. So the tailwind that we're seeing for millennials is largely a U.S. and maybe India-centric story.
But I'll give you another boom. That's the baby boom, Tom. I mean, aren't we at a point where a lot of them are retiring and starting to pull down on 401ks, IRAs, and other assets that may be invested in stocks? Is that not a headwind?
Yeah, I mean, they're going to be exiting the workforce and their consumption is going to decline. So that's a bit of a headwind. But you have to consider that there's $100 trillion of U.S. household net worth, of which around $70 trillion is controlled by boomers and silent generation. that's dynastic wealth. I mean, even at a 3% or 5% burn rate, those net assets are actually going to grow. So what I think you have to think about is that 68 trillion is going to be inherited by millennials. I mean, I think it's actually a pretty big tailwind as that money gets passed on to the next generation. So the last point I'd make, and I think this is the most important, I don't think people put enough thought into demographics. And I mean, I think there's general work done, and Harry Dent and all these have done a really great job because they look at total population. But at Fundstrat, what we've done is we've really extracted that and really looked at a much more narrow set of a generation, which is people aged 30 to 50. But here's total population. So I've listed the 6 major economies: US, Europe, Germany, Japan, China, Russia. And the first shaded column was the UN's projection for population growth in 1999 for the next 20 years. And here's what's interesting. In 1999, that's 20 years ago, the UN projected only 2 countries to have population growth: US and China. Which 2 countries kicked butt in the last 20 years? Europe was projected to have 0, Germany 0, Japan 0, Russia 0. Only US and China captured any value as an economy. The next column is the projection for 2019 to 2039. Only one economy is projected to have any population growth: America. China's population is not projected to grow for the next 20 years. I think you can make a credible case that China's growth story is over. It's going to look like Japan in the next 20 years. Now, it doesn't mean you shouldn't be selling goods to China, but it means you should only be targeting wealthy people in China because there's really no population growth. And why does wealth matter? Well, this is a chart from, this is data from Credit Suisse. This is household wealth by country. So household is individual's wealth. The world has $300 trillion of wealth. I mean, that's 5 times global GDP. Okay, so there's a lot of wealth. 100 trillion is in America. 1/3 of all the money in the world held by households is in America. And then 50 trillion is in China. 2 countries control half of all the wealth in the world. Think about that. I mean, no other country matters. You might think that the Middle East has a lot of money. Like Saudi Arabia is the wealthiest country in the Middle East, and household net worth is only $1 trillion. Chinese households own 50 times the wealth of Saudi Arabia, and yet all the countries that own resources, whether in Latin America or Middle East, have never been able to hold their wealth. Only America and China. So if you want to think about what matters for you and how your money should be positioned and what geographies you should focus on, I know people have been telling you to focus on emerging markets or growth. The growth is just in the US. And how do you see this growth? Well, I'm going to plot population growth. So the left chart is the US population growth minus G7. The middle one is US minus China. The third one's US minus Japan. Notice in each case, US population growth is pulling away. It is turning parabolic, actually, because those inflections are only 2 or 3 years old. But the most important age group is the 30 to 50-year-old. So in America, that's the dark blue line. Notice how it's starting to hook up, going parabolic in America, and every other country is tanking. The US has a massive demographic tailwind that no other country really has right now. And it's because of this. So that's the growth rate of 30 to 50-year-olds since 1930, okay? And again, you can see it's really cyclical. It kind of says follow generations. You can see the boomers caused this number to surge from the 70s all the way through the 90s. Gen X, which is my generation, was a smaller generation, so this number actually fell. It's been negative since from 2003 all the way through 2016. For the last 13 years, the number of people aged 30 to 50 has been declining. I mean, think about it, right? How can you have growth in America if the number of prime age adults has been declining? Well, that's why we've kind of stagnated. But as you can see, in 2016, this number turned positive, and here we are in 2019, that's the orange line, and it's actually starting to take off. It's actually sort of right where we were in the mid-70s, so it's a really bullish time to be betting on America. And if you don't think it has any influence on what the stock market can do, I put two charts together. I think it's an interesting coincidence. The top chart is that 10-year total return of equities. You guys remember from the other page, right, where I said S&P 19,000. The bottom chart is 30 to 50-year-olds, 5-year growth rate. It's the exact same chart. Basically, stock market cycles follow the movement of a 20-year generation, age 30 to 50. And this is turning up. If this is playing out, I think we're going to have a mysterious levitation of equities because of the impact of the 30 to 50-year-olds. You might ask, why does this happen? Here's the reason it happens. The Urban Institute tracks the amount of debt held by different age groups. The only age group that borrows money are people between the age of 30 and 50. You can see it starts to rise at age 28, it peaks at age 50. Why does debt matter? The debt borrowing is the multiplier for an economy. Like when people borrow money, that's how GDP grows faster. And they also start doing things like buy houses and cars. So the most important age group is the 30 to 50-year-old because they're the only people borrowing money. After age 50, people actually delever. And so this number is going up. And in fact, you can see it even correlates really well to home price. The top chart is aggregate value of housing stock in America as a percentage of GDP. The bottom is that same generation chart. It's the same chart. The only divergence was 03 to 08 because home prices were going up, but the number of people was falling. It bottomed in 08. The housing crisis is really because of a demographic issue, and now we're reversing it. I think I would be super bullish on housing right now. Okay, so let's talk about the demographics. Now, all technological change, I've been in research for 25 years, is always driven by a generation that adopts it. You've heard this many times from other folks, but let me talk about the millennials for a moment. Millennials are someone born between 1980 and 2000. It's the single largest generation ever in America. You can see this number here. It's almost 20 million larger than the boomers. And if you don't think generations matter, on the right side, I actually listed the year each generation peaked. So the greatest generation peaked 1929. Silent generation peaked in 74. The boomers peaked in 99. Anybody who's a historian of the economy knows that those are all turning points of the economy. The Great Depression started once the greatest generation peaked. We had stagflation and a huge period of misery after the silent generation peaked. And of course, we had the dot-com bubble burst when the boomers peaked. Generations drive major change. And millennials are huge, 2.5 billion globally. It's 40% of the adult population. Now, you might all think, look, I thought millennials were a bunch of lazy people. And that was probably true that millennials were young. Because, see, from 2005 to 2015, millennials were primarily teenagers. But starting in 2018 is the year that the millennial population is actually mostly adult. So today, millennials are where the boomers were in 1982. So we have to think of them as how are they going to affect the economy going forward, and their impact is huge. This chart shows you the distribution of income by generation. Within 10 years, millennials will be will control the largest share of the wallet in the US. And here's some evidence. This is from Chase, their credit card data. This is year-over-year change in credit card spending. You notice there's only one line that's dark blue, and that's above zero. That's the millennial credit card holders at Chase. Everybody else at Chase is actually seeing a decline in spending. The only reason credit card spending is growing at Chase is because of millennials. Okay, and then, sorry, I just want to fly through this so I can cover everything. 92% of millennials don't trust banks. This is from First Data. 71% of millennials would rather go to the dentist than listen to what the bank says. And 33% believe that banks will actually not exist in 5 years. So millennials hate banks. But according to First Data survey, millennials will control $7 trillion of assets in a few years. So let's just say millennials inherit all this money, $700 billion. What if they put 10% into crypto? I'm just throwing that number out. That's a $700 billion allocation into the crypto market. And as you guys know, the multiplier in crypto is monstrous. It's probably 20 to 25, which means that if the millennials move that much money into crypto, just in the US, we're talking about a $2.5 trillion market. Okay. Finally, I just want to cover a few more things very quickly. Crypto's gaining some credibility in the US. I don't know if you're familiar with CFA. I think most of you guys are. It's actually a quasi-regulatory organization. The CFA is adding crypto to its curriculum. And the question that we get from our clients all the time is, look, crypto doesn't pay a dividend, it has no intrinsic value. I won't cover it here, but in the last 20 years, a lot of rules have changed. We never had negative interest rates before. Companies that had no profits used to never go public. Today, 98% of companies that go public don't make money. But I think the two ways people are going to look at crypto, one is the store value. Okay, and today the store value market is $280 trillion. So most people think Bitcoin replaces gold, and that's a good analogy, but gold's only a $9 trillion market. Art is actually a larger store value market. Family offices allocate more money to art than gold, and that's a $17 trillion market. So again, crypto is not even 0.1% of that market. And the last way I think you need to look at crypto, I'm skipping ahead, is network value. So we addressed this at the panel today, but I want to highlight why that matters. This chart just shows you the number of internet users that existed by year, and I list the year each of these companies was created. So Amazon, which has been the best investment ever in FANG, is because it was created when there were only 7 million internet users. And Facebook was created when there were 580 million. And as you can see to the right, there's 4.2 billion internet users today. Believe it or not, if you just did Metcalfe's law on that user base, 75% of the return of FANG was explained by the year that company was formed and how many users were on the internet at that time. So you didn't have to do a lot of work. You could just buy who was the best company. You might wonder, how do you know who's the best company? It turns out Internet 1.0 and Internet 2.0 were all created around the same time. Facebook and MySpace were only incorporated 1 year apart. Google and Yahoo were only created 3 years apart. Okay, so Internet 1.0, 2.0 were created at the same time, and it took less than 5 years to pick the winner from the loser. So in Facebook, it only took 5 years for them to surpass MySpace. It took 3 years for Google search to surpass Yahoo. So in internet time, it only takes 3 to 5 years to figure out who the winner is. I want to skip ahead a little bit here. Well, in crypto, Bitcoin's been around for 9 years. That's probably 3 generations of crypto time versus internet. So I think when you think about how you want to build your crypto FANG, I think Bitcoin has to be one of them. Lastly, I'm going to just rewind a bit here. Before FANG, there was consumer stocks in the 80s. Consumer stocks did almost as well as FANG, and the ticker would have been, instead of calling it FANG, you would have called it Wicha Hugada. Just kidding. That's why they didn't want to call it FANG back then. But $1,000 in those names turned out to be $1.2 million by 15 years later. So every generation sees a chance to make thousands and thousands of X on their return. And I think the easy way to think of it is active wallets. There's only 50 million active wallets today. If we look at PayPal, that's a 5X in terms of number of holders. If we get to Visa, MasterCard, that's 4.6 billion, that's 100x. Well, if you have a 100x increase in wallets, you're going to have 100 times 100x increase in crypto value, which is, 10,000x. So again, I think the future's bright. So with that, I got to wrap up my presentation.
Thank you for watching. If you find the content useful, please subscribe, hit the like button, and share with your friends. Please also turn on that ring bell so that you will be informed when there's new content about Tom Lee.